Is the real estate market rebounding? Hi, my name is Dennis Wells. I'm a mortgage advisor and the host of Faith and Funding podcast, and I'm here with your weekly national real estate market update. We had a ton of housing data snap back last week, as it should have from the holiday impacted week before. Active inventory, new listings, and weekly pending home sales all grew above the trend. This usually happens when we have a major holiday the previous week that slows data. But mortgage rates have also fallen some, and we were almost back to the 6.25% level until late in the week when the peace process appeared to have stalled a little bit. So, was the growth more from a rebound from Easter or falling mortgage rates? Let's take a look and find out. We start off with weekly pending home sales. Our weekly pending home sales data provides a week to week perspective, and although results can be affected by holidays and short term fluctuations such as the Easter weekend, housing demand snapped back from the previous week's negative year over year print. Was it all about the mortgage rates falling? I don't believe so. We usually do get a rebound from a holiday week, and we weren't far off from showing growth in the data. So I'm going to go more with an Easter week snapback than the improvements of rates dramatically helped the pending home sales. Now, weekly pending home sales usually take 30 to 60 days to hit the closed sales data. Typically, mortgage rates above 6.64% and those breaking over 7% really impact that data negatively. Under 6.25 has been the sweet spot over the past several years, excluding some short term variables. So here's a look at the weekly pending sales last week over the last 2 years. Last week it was at 73,241. In 2025, it was 71,775. So a nice little bump there. Now we look at the purchase application data. Purchase application data is a forward-looking indicator. Growth here leads home sales by roughly 30 to 90 days. Last week, we'd seen a 1% week over week decline and a 3% year over year decline. Higher mortgage rates have impacted this data line, and we aren't back below 6.25 yet, but this week's data coming up should be interesting as rates have fallen closer to that 6.25%. Now, the 10-year yield and mortgage rates. We recently saw a positive move in the 10-year yield and mortgage rates as the bond market has been trying to get ahead of any Iran war deal. Both times we have heard about an end of the Iran conflict, the 10-year yield has gotten back towards that 4.25% mark. Mortgage spreads are also improving, so mortgage rates are moving closer to the all important 6.25% right now. Mortgage spreads. Mortgage spreads remain a positive story for housing in 2026, as mortgage rates would have easily been over 7% in 2023 and 2024 and close to 7% in 2025, given the current 10-year yield level and the worst spread levels back then. The spreads were already deteriorating in February as yields fell, compressing volatility on the downside, and the war took spreads back up towards 2.11%, but now they're down to about 2%. Historically, mortgage spreads, the difference between the 10-year rate and the mortgage interest rate, range from 1.6 to 1.8%. Last week, spreads closed at 2%, down from 2.05% the week before. However, I wanted to compare last week's rates to the worst levels of the spreads over the past 3 years, given the 10-year yield at its current level. If we had the worst mortgage spread of 2023, mortgage rates would be 7.39% today, not closer to 6.375. If we had the worst levels of 2024, mortgage rates would be 7.02% today. And if we had the worst levels of 2025, mortgage rates would be at 6.83% today. So we're still about 0.5% lower in interest rates than we were last year. Now let's take a look at housing inventory. Housing inventory growth was very light 2 weeks ago, which was impacted by Easter. Now we have had a solid week of inventory growth, which is that rebound impact. So if you average the 2 weeks out, the inventory growth story has really stayed relatively the same this year. We have gone from a 33% year over year growth in inventory at the highest point in 2025 to 3.21% last week. In the past, inventory growth picked up amidst higher mortgage interest rates, softening demand, and rising year over year new listings. Even with the Iran conflict pushing the mortgage rates higher from near 5.99 towards 6.64 recently, 2026 has had the lowest rate curve for the housing market to work from since 2022, and rates have not risen above 7% in a while. So weekly inventory change from April 10th to April 17th, it rose from 724 to 743. Last year, at this time, inventory rose from 702 to 719. Now, new listings. New listing data has been a bit disappointing so far this year, as we were hoping we would see some weeks with new listings ranging from 80,000 to 100,000 homes during the seasonal peak months, which we would see in a normal year from, say, 2013 to 2019. We should at least get some weeks over 80,000 this year as we did last year, but we're not really confident of any growth beyond that. New listing data had a solid week, though, rebounding from the Easter weekend. And remember, for context on these numbers, during the housing crash, new listings ranged from 250,000 to 400,000 per week for several years. So here's a last week's new listing data for the past 2 years. In 2026, we've had 77,919. In 2025, we're at 77,005. Now let's take a look at the price cut percentage. Typically, about one third of homes undergo price reductions before they sell. This reflects the dynamic nature of the housing market. As mortgage rates and inventory rise together, the percentage of price cuts increases, and the price cut percentage is slightly lower this year than last, and housing inventory has grown very slowly in 2026. Let's take a look at the price cut percentage for last week. 2026 was 34.65. 2025 was 35%. So pretty flat year over year. What's going on in the week ahead? Well, Iran. We also have consumer confidence, quarter one gross domestic product, and personal consumption expenditures. Of course, the news about the Iran conflict runs the show with the bond market, which impacts housing the most. Other than the conflict, however, Wednesday is really going to be the day to watch. We get gross domestic product, personal consumption expenditure, and the employment cost index. If they all drop the same morning, for example, if GDP disappoints and PCE is still elevated, you've got stagflation language creeping back into the conversation, which is a rough combination for the bond market and by extension, mortgage interest rates. That being said, the biggest story next week will be any new updates on the news from the Iran conflict. Again, this is Dennis Wells. Thank you for watching my weekly market update. And please please go ahead and subscribe to my YouTube channel. And if this has been valuable to you, please share this with any friends, family, coworkers that might be interested in having a conversation about real estate, mortgages, and the financial market. Hope you have a great weekend.